Daniel Loeb. Dan Loeb is the CEO of Third Point, a $2 billion event-driven hedge fund based in New York City. Before founding Third Point in 1995, Dan was vice president of high-yield sales at Citigroup, a senior vice president in the distressed debt department at Jefferies & Company, and an associate in private equity at Warburg Pincus. He is a trustee of Prep for Prep, a nonprofit organization, and Third Way, a nonpartisan progressive political think tank. Mr. Loeb graduated with an A.B. in economics from Columbia University. He is married to Margaret Munzer Loeb and lives with his 3 children, Jacob, Ava, and Biggie, a fierce miniature pinscher. Dan is an avid surfer, yogi, art collector, and is in training for 4 triathlons this summer. He has studied Torah with Rabbi Hedge, who many of you may know, and who also officiated at Dan's wedding for over 6 years. And personally, I want to say that about 2 years ago, Dan delivered what I consider to be the funniest speech ever given at a Jewish organizational event when he was honored by the JAC. I still laugh when I think about it. So, Dan Loeb.
Thanks very much for setting expectations way too high. I actually, when Matt asked me to do this, I thought this was going to be like a small group of 10 people, and I'd say a few words and answer some questions, and I didn't think I would be such a formal address, but I will try to say a few words and then take your questions. The first thing I'm going to say, since this is the Wall Street group, is something I tell all my analysts: turn off your BlackBerries. I don't want to see people scrolling through their BlackBerries. I won't be doing it up here. So I think that's one of the key. I think people come here for a couple reasons. Maybe one is to learn about investing. Maybe one is to learn about career path and how to get into this business. So I appreciate everyone coming to hear my story about those things. But before I go into that, I've been obsessed with this idea of story. I mean, you came to hear my story, and I guess I run a hedge fund. It's been relatively successful, so I've got 80 people here on a Wednesday night to hear it. But really, everybody, there's some great stories out there. I think everybody in this room could sit down and hear your story, and I'm sure there's an arc of events and things. And I read a book. The first time this really hit home, I read a book by Rohit and Mistry called A Fine Balance. And 2 of the most interesting characters in the book, I think their names were whatever, there's some Hindu names, and Prakash and Vishwar. And they came from the lowest caste in India. They were leather tanners, and anyway, but it was a great story. I was captivated. I thought, God, every time you get in a taxi drive, every time you see a taxi driver, maybe it's a person that cleans your home, maybe it's someone in this room, they have great stories to tell. So thank you for hearing mine. I'm not saying it's better or worse than anybody else's story. It's just another story. The other thing I wanted to talk about story is not just a story involving your life, but then we also tell ourselves stories about that come out of our life experience. I'm Dan. I'm a good investor. I'd like to be a better surfer. I'm good at this, bad at this. But sometimes these things set our expectations of life and really determine what we can do. I'm a little older than you guys, so my grandparents had stories about the Depression, about World War II. They had relatives that suffered in Nazi concentration camps, and those stories really affected them. They aren't just stories that made them who they are, but really affected the kinds of decisions they made, their perceptions of the world, and their basic practices. So I think it's very important as a human being, but I'm going to use being an investor as sort of a prism, because I think in order to be a really good investor, you need to be a little bit of a philosopher as well. It's not enough just to look. There's a zillion people out there that have gone to Wharton or other top schools. They've studied accounting and finance. They can do valuations, DCFs. But I think you have to be a little bit of a philosopher to be a good investor. And I think the fact that you're all here, the fact that you're interested in Judaism and Jewish community and the philosophy of Judaism, and you're really lucky to have great teachers like Matt and Rabbi Lawrence and Junior and El Jefe Heshi to help you in that journey. And it's important for life, but I think as an investor, it's important to think about these things. So before I go into kind of the story part of things and talking a little bit about investing, I also want to talk about an approach to investing and running the business that I think has been really important for me. And it didn't come naturally. I mean, I think when I started in business and when I started my own business, I really thought about the tasks that I had at hand and getting things done. I started out in private equity, so I would have an assignment to do a bunch of comparables and projections for a company and do a bunch of market research, and I do the job. But running my own business, it's given me the opportunity to take a step back. And it hasn't just been an opportunity, as you'll hear in a minute. It's really been essential to my survival and success in the business to take a step back and really think about what are the principles, what are the guiding principles for my business? What kind of culture do I want to create? What's the organizational culture? What's our research culture? And what are our philosophies? And how do we implement practices that are consistent with that? And I'll talk about in a minute sort of the challenges that we faced last year, how we've emerged from those challenges, and what the opportunities that we see. But I really couldn't have gotten through that without a couple things. First and foremost, it's having a really supportive wife and family and an interest in things that are more important, right? I mean, what do you think the guiding principles were for someone like Bernie Madoff? I don't think it was, hey, the investors come first. That's, I would say, as a manager at Third Point, the investors come first. And when I'm not sure about a decision that I want to make, because sometimes tricky things come up in a kind of a gray area, maybe there's a close call in how we're going to value a security, or there may be some restructuring in terms, or last year a lot of people put up gates in their hedge funds. So I think if you were a principles-based investor and you were sitting on enough cash to meet your redemptions, you would have figured out a way, if you really believe that your investors come first, to pay them back. But a lot of people put themselves first. And interestingly, or maybe not ironically, but maybe as you would expect, many of those people who did that and didn't put their investors first, but put their own business interests first, are out of business now because they pissed everybody off and they forgot their basic principles because they panicked. And this keeps you from panicking in difficult times by having principles. Other principles would be things like, what sort of culture do we want to create? There are lots of ways to structure a hedge fund. And I don't know how people work in the investment business or other, but there's the kind of dog-eat-dog philosophy that, you have your own book, you have your own book, you have your own book, and I want you to generate as much P&L and deliver that to the mothership. And that's great. Some people have that structure, and it's based on a different kind of philosophy and culture. At Third Point, we have a different culture, which is one based on teamwork and cooperation and a real focus on back to the investor coming first, but a real focus on what's good for the whole, what's good for the whole firm, and how are we going to succeed as a firm. So what does that do? It prevents hoarding of information. It prevents people from running, backbiting against other people. It prevents people from, doing a lot of bad behaviors. What does it create? It creates people that are supporting each other. Somebody maybe outside of your industry is doing something, you'll want to help them. Someone in marketing wants you to come in and meet with an investor, but you're not getting paid for that. You're getting paid for your investment ideas. But if instead you're getting paid on the overall profitability of the firm, and you have a culture then you're happy to go spend that time and help that person out. It's just a more pleasant atmosphere for us to come to every day. So things like teamwork, transparency, honesty, creativity. And then in terms of how do we invest, just to take it down a level, we have a value-based philosophy, not values, value orientation. So we're not momentum guys. We're also not macro guys. We invest in things where there's a fundamental analytical framework that we can understand, pretty much explain using, third or fourth grade math, and with a set of dynamics that we also understand, probably a higher level of legal analysis and accounting analysis, and then regulatory analysis as well. So I'll come back to that in a minute. There was a time, last year, I'll get to the part where last year was a really tough year. We forgot some of those investment, not so much that we forgot them, but we deviated a little bit. We extended the definition from what our core competencies were. And we ran into a few hiccups. And it wasn't until we really got back to that, grounded ourselves in our core principles, core investing principles, that we kind of, got our mojo back. So, the last thing I'll say, just as far as a firm and culture, I think everybody knows, everyone that works in my firm knows that there are a few other things that are very important. I always ask people about their families. I mean, maybe this sounds sort of apple pie and hokey, but I think it's important. I don't want people to sacrifice their family to put in FaceTime to work all night long. Our community is important. So, for example, we had our holiday party at the Harlem Children's Zone this year instead of, we usually do it at a fancy hotel, because Harlem Children's Zone had just lost its funding from Lehman Brothers. So I thought, when I read about that, I thought, let's put the money that we were going to spend on wine and fancy catered food, and let's do it up there. And it was actually great. People loved it. And I'm a little bit of a health nut, and I think people at the office that's great too, because I think if you are physically fit, you're more apt to make smarter, your judgment is better, your energy levels are better, and we sponsor anybody who wants to compete in a triathlon. I paid for it, and I just sent it out, and I got a random email from a guy in the accounting department who I don't have a lot of interaction with. Probably hadn't spoken to him more than a couple times in 6 months, and he said, Dan, thanks so much for sponsoring the triathlon. You motivated me to do it, and since then I've lost 50 pounds. I'm doing a half marathon, and I'm doing another one, and I was a football player in college. I just had lost my way, and so I mean, that's a great feeling to know that you can have that impact on people's lives, because I think it's good business. It's also just good for people around you. So I promise I'm going to tie all this rambling together in a way. So I was interested in investing from a very young age. Almost bizarrely, I was interested like at 5 or 6 in just fascinated by things. I mean, I had a great aunt who was the founder of Mattel Toys. Her name was Ruth Handler, and her husband Elliot started the company. So I had this entrepreneurial history in my family, coupled with sort of the immigrant struggle. But I also associated success in business with Hot Wheels and Barbie dolls, and I think it was a very powerful enforcer early on to like business. So as time went on, I had this nerdy interest with business. I started a skateboard company. Kind of straddled 2 worlds. I surfed and I skateboarded, but I was also in AP classes. So I think I remembered myself as being much more of a nerd. I went back to my 20-year reunion, and I had a girlfriend then. This was before I got married, not Margaret. And I said, well, look, everyone's going to tell you what a nerd I was, but actually, it turns out I guess I wasn't as much of a nerd as I remembered myself being. But anyway. So I had a skateboard company. I then went to Columbia. I worked at Warburg Pincus in private equity. But my real passion was always the stock market. I worked at a firm called Lafer Equity Investors in risk arbitrage and learned that craft. And my real trajectory took off when I started on the sell side at a firm called Jefferies in 1991 at the beginnings of the distressed debt market for that phase. there was a distressed market in the 70s when Mike Milken exploited it and did a great job. But then this was the post-Drexel. You guys are too young to remember, but if you read your history books, Drexel Burnham went bankrupt on Valentine's Day in 1991. And I started Jefferies in September of 1991. Started out as a research analyst, traded trade claims, bank loans, covered accounts, worked as helped position bonds, and at the end of that period, thought I could do this as well as others, but needed a little bit more money to get started, and took a job at Citigroup. Then I started Third Point in June 1, so it's been 14 years of 1995 with about $3 million stitched together from family members and friends, and had a phenomenally fortunate run. I was lucky to start it when I did with the focus that I had, and was looking at parts of the market, distressed debt, special situations like spin-offs, demutualizations, post-reorg bankruptcies, et cetera, during a period where that was a good strategy to be in. And a few other things I learned along the way during the time of the internet bubble, because I had a very fundamentally focused investment philosophy. I never participated in the craziness of the internet bubble, but I missed the crash. In fact, I profited from the crash because at a certain point when I thought things were really breaking, we started to short stocks and did very well. And that really set the stage for Third Point to raise a lot of capital, because when they saw that we made money when the market was falling apart, then we attracted a lot of capital. So the next distressed debt cycle was 2002, 2003, and we played the back ends of the bankrupt securities in that market. And we had our best year ever. We're up 50% in 2003, 30% in 2004, and then segued into some other things for the next couple of years, did well in energy and emerging markets, and had our best year ever in 2007 in terms of, the firm made $1.5 billion of profits. It was just a crazy year. So which brought us to 2008. Things started out really good, printing money in energy. We had some special situation investments that were good. We were short a bunch of financials, and those were going well. Everything was going great. And then July came. The energy markets fell apart. And I'd kind of let my risk disciplines get a little lax. We got just clobbered in energy, lost about 10% that month. And then in August, we had another bad month. September, the months are kind of blurring together, but I'll just kind of, September was August was when all the government intervention started. So my financial shorts went through the roof. I lost faith. I panicked. I covered everything at the top. They tanked afterwards. And then everything else that I owned seemed to fall apart, except for my short positions, which kind of saved the day for us. So we ended up the year down about we had a managed account down 22%. Our funds were down about 32 to 37%. And we had invested in a couple of private transactions in the LBO of Chrysler. There was a third-party fund that we had invested in that also tanked. It was a mess. I just thought, God, lucky 13. Spent 13 years building this business, and I felt like it was just slipping between my fingers. And the organization was demoralized. I had huge overhead, and things didn't look good. Then the redemptions started coming in, so we lost a third of our capital, about $1.4 billion in redemptions at the end of the year. So I thought, well, at least I have my health. But the business was challenging. But on the one hand, I thought, well, we lost 1/3 of our investors. On the other hand, there were people who did less badly than we did that lost their whole business, lost 2/3. So I thought, you know what? Thank God, we still have this glass is 2/3 full. We still have 2/3 of our investors, and it's really testimony to our track record and the confidence that people have in us that they stuck around. So we started out this year, doom and gloom, end of the world, markets are really falling apart, we were short, we had protection on European sovereign debt, we had bought a lot of gold, we were short the Swiss franc and the Japanese yen. If I could somehow stockpile guns, I would have probably done that for Third Point. I just thought it was a really bad time for the world, and it was. And then February came along, and we felt really good again. We were up 4%. The market was down 25%. We made all these smart defensive bets, and we did what we're supposed to do. We protected our capital during a tough time. March 8th came around, which was the market bottom. It started to rally. The 4% profit was 3%. No worries. 3% went to 2%. Then by the end of March, we were even because the market kept rallying. I was like, come on, Mr. Market, is that all you got? Because I knew that everything that I knew about the economy globally, let's get back to stories again. This was my story about the world, and this is why it's very important. This is why I started talking about stories, and why I want you to think about stories as a concept on many different levels. My story was this. Latvia was teetering on collapse, as was Bulgaria, as was the Ukraine. The Western European banks had massive exposure to these Eastern European sovereign nations. The banks were being supported by the central governments. The governments in Europe were going to continue to support them until they defaulted. I had all kinds of statistics and charts to demonstrate that this was for sure going to happen any day or any week now. And meanwhile, in Japan, they were going to collapse the Chinese currency. The Chinese economy was on the brink of insolvency. Forget about our economy. The banks were basket cases. And this was kind of ingrained to me. I talked to the smartest economists at Harvard and places like this, and they all, this was like everybody knew this. So this was the story that we were telling ourselves. And if you turn on TV, there's still people out there that believe, this is just a bull market, a bear market rally, and that we're in a hopeless situation. So that continued for a couple more weeks, and 2%, the 0% turned into -2. We're finally, in the first week of April, we're down 7% again. So once again, it's like, oh no, it's like, I don't know how any of you surf. It's like being out in the waves. You paddle out for the big set that's coming. You make it over a wave. You're like, and then a big wave comes, knocks you down, and you get up, you try. I see there's not a lot of surfers because you're looking at me like, what are you talking about? But anyway, just trust me on this one. And you keep going out, and the waves keep knocking you down. And I really felt that way. So at this point, it's the first week of April. This is not that long ago. I have nothing in the portfolio because I've been focusing on shorting. The team's demoralized. We have more redemptions coming. And the cliche, I had to sort of dig deep because it's not my job to fold up my tent and go home. At the same time, part of me thought, wow, this is really an unusual time that we're in. There's a lot of illiquidity in the marketplace, and there's got to be some opportunities on the buy side. And you also have to kind of listen to the market and challenge, be willing to have your stories be challenged and to change them. So there's a fine line between sticking to your beliefs. There's a distinction between sticking to your beliefs that you know to be true and sticking to an opinion you have or a theory that you have which may or may not be true. So, investors come first. I'm pretty unshakable in that. The market's going up, the market's going down. I'm open to debate on that. Same with a stock. So the turning point for me was, I don't know if any of you are familiar with this Citigroup Pref Common exchange deal. Well, this set of Citigroup has hundreds of billions of dollars of liabilities. It was insolvent for all intents and purposes, but they did an interesting transaction where they exchanged preferred stock, which is at the bottom of the capital structure, into equity. They also got a lot of government goodies guaranteeing things. But gave them the capital that, combined with their own earnings power, made Citigroup a financially viable entity going forward, even though if you looked at it and said, well, if you closed it down today, they wouldn't be able to pay their liabilities. And I thought, well, if Citigroup can do this, we went through a similar analysis to Bank of America, JP Morgan, Wells Fargo, and we said, wow, these guys can all do it. And hey, I think the system's not broken, it's not insolvent. Meanwhile, the IMF fixed Latvia, the Ukraine, and Bulgaria. No, it wasn't even Bulgaria. It was anyway, one of the other countries over there having a senior moment. Hungary. Sorry, it's not Bulgaria. It's Hungary. So, and the IMF fixed those countries. So that part of my theory was sort of shaky right now. The banks weren't shaky. I thought, wow, this guy Nouriel Roubini, who's been going out saying it's the end of the world, maybe he's not right. So I had this, this light bulb went off. I said, wow, I'm a little bit late to the party, but it's not, this thing is just getting started. So, first thing we did is we got out of all of our macro trades. So that was me sort of coming back and saying, regrouping to my core competencies and our core principles of what we are, and saying, hey, these things may or may not be right, but it's not really what we do best. It's not consistent and congruent with our investment philosophy. So that was kind of killing two birds with one stone. We got rid of the disaster trades, and we got refocused on what it is that we do: distressed debt, spin-offs, risk arbitrage, et cetera. So then we covered our financial shorts, and then this was also kind of a leadership thing. I got the group together. I said, guys, no more meeting with economists, no more talking about interest rate steepeners or currency trades. This is our set of what we do. It's a relatively narrow set, and I want you to look at trust preferreds of banks, and I want you to look at risk arbitrage deals and bankruptcies, and I want you to especially look where the government is intervening, because the government's been throwing breadcrumbs. If you follow the government's breadcrumbs, there's a lot of, maybe that's a bad analogy, but anyway, if you follow what the government's doing, you're going to make a lot of money. So we bought things like Chrysler Finance Company bank debt, which doubled in 2 weeks leading up to the bankruptcy of Chrysler. We bought insurance companies like Lincoln National and Hartford that were rescued by TARP. We bought Bank of America preferred stock. We bought some busted ARB deals. So the good news is that, look, this is an unfolding story, and as long as I'm doing this business, it will continue to unfold. But at least in this period of time, we've went from down 7% to up 7% in performance, which is a dramatic move in a 6-week period. The investors are excited again. The team is energized, and I can tell a story to prospective investors such that the outflows have shifted to inflows, and it's all about staying alive to fight another day, and I'm enjoying doing what I'm doing again a lot. So anyway, I just thought I would share this anecdote about the last year and this year, and maybe just use that as a jumping off point for questions that you might have about anything you might want to ask about. We'll start this way and move over. Go ahead.
Do you think the current market rally?
I don't know. It's not sustainable at this continued pace, because nothing grows at 40% every 3 months. But do I think the market will be higher or lower than it is today at the end of the year? I think, I'm no oracle about markets, and my wife will be the first to, her judgment on markets is probably better than mine. But just based on kind of my bottoms up view, we've shifted most of our capital is going into credit markets. So I don't care as much being a distressed debt holder, buying things like, Ford Finance Company revolver at a 22% yield. So what we do isn't typical. We're not making a bet on, hey, I think Google's going to go up. So we're an event-driven shop. So a lot of what we're doing is risk arbitrage, credit plays, things like that. So we're, I wouldn't say market neutral, but we're a little less sensitive. So I'm always, I would say it's a coin, from these levels, I'd say it's a coin toss. I wouldn't be surprised if it was up 10% or down 10% from here. I'll keep going across the room this way. I saw another hand over here. Changed your mind?
I had a similar question, but a slightly different flavor. What do you think of inflation risk in the next?
Inflation risk, it's huge. So, we're trying, we want to, a lot of the bank loans that we own, inflation and interest rate risk. So we own bank loans that have floating rate coupons, and we're just kind of starting to dig into things like apartment, assets that are backed by things that can move with inflation, like apartments and hotel companies and basic materials, energy, things like that. But it's very hard to have the sort of fiscal policy and monetary policy that we've put in place without risking. I mean, I think the government thinking is that deflationary pressures will offset that, but it's hard to see, and that's why you have so many smart people buying gold right now.
Do you have any opinion on Goldman Sachs and market manipulation?
I'm sorry, the question?
Relating to Goldman Sachs and market manipulation.
Do I have a question about Goldman's?
Opinion.
What?
Opinion on the
No,
situation of Goldman Sachs, yeah.
I don't really have. I mean, I have a good relationship with Goldman Sachs, so I'd like to keep it that way. So I'm going to just not answer that. But I don't think that, I mean, it's such a. I mean, Bernie Madoff said that. I don't know. Do any of you see the YouTube thing where Bernie Madoff talks about how he could never get away with a crime because he'd get caught because he's so regulated. But Goldman Sachs really is very regulated. And anyway.
Jim Rogers recently said that in 10 years he sees farmers as the people that are going to be rich in the world. And he sees them, they're going to be the ones driving the Lamborghinis because of the commodities. What do you think about that? Gina is usually the right most.
I've been saying this since 1985.
Yeah. Yes. Oh, no, I'll answer. So the statement in question was that Jim Rogers thinks farmers are going to drive Lamborghinis,
He says to go out and start.
and you should start a farm, and what do I think of that? And it's like asking me a question about women's fashion in 10 years. I'm just not, this is not.
How do you feel about commodities? Do you think that what he's saying, meaning that just basic goods are going to become a necessity to people more than they are now? Meaning, is it going to be, they're going to be more valuable, not just because of inflation, but just because there's so many people in the world?
It's not just so many people, but so it's also demographic shifts where you have more wealthier people, and as the Chinese economy grows, and my time frame that I look at from an investment portfolio, from an investment perspective, is more like 1 or 2 years. I mean, I think these are interesting things that we can all theorize and philosophize about, but I'm better at talking about what I think distressed debt securities or mortgage securities are going to do in the next 3 to 6 months, and what farmers, are going to get for wheat in 10 years. I don't know. He could be right. I mean, he's been a big commodity bull. He's one of the first guys to get it right. He kind of stayed bullish through the boom and the bust, but it's interesting. There's a lot of these pundits. You saw very few people, and only a couple of hedge fund guys that were inherently bullish or bearish, that shifted, at the beginning of the year. And so Rogers has been a commodity bull all through. Rubini was a bear early on when the economy looked good. He was a bear when it hit bottom, and he's still a bear. Abby Joseph Cohen's been more or less bullish the whole way. It's rare to see. There are a couple of hedge funds though that just nailed it just right. That the guy Lansdowne was, was massively short, went long at the bottom, and it's hard to do that. Green shirt.
Do you think the hedge fund fee structure will evolve, start changing?
The question is, do I think the hedge fund fee structure will evolve? And I certainly hope not. It's one of the great things about this country is hedge fund fee structures. That I think it should be sacrosanct, and maybe I've been lobbying Congress for an amendment to the Constitution to memorialize the 2 and 20. Look, there's clearly been a shift. There's been a power shift between investors in hedge funds, and it's an ebbing and flowing relationship. And we've had a very good partnership with our investors. As we've grown, our investors have grown. Some of the funds that invested with us in the beginning built their businesses on the back of our performance. And when we got hurt, they got hurt. We're seeing some of the institutions now that carry a little more clout. CalPERS, Utah's been vocal about it, trying to get modifications of fees, looking at things like clawbacks, fee reductions, expenses. I think all these things are important to address, and we're thinking about. We're looking at most things. Right now, a lot of the industry is in a high watermark situation where either they're not earning incentive fees, or in our case, we have a modified incentive fee. So the incentive fee thing isn't an issue. I think that discussion will wane a little bit. People really are looking for the best managers with the best performance, and whether you're paying 1 in 20 or 2 in 20, 1 in 15, if the guy's performance is bad, it's not going to matter. So I've tried to get people to focus on that net number, and we haven't. I think there was a lot of talk about that at the end of the year. It's quieted down quite a bit. What you will see, though, is the terms of the partnership agreements will change, where I think people will have to be much more user-friendly, because I don't think as many investors put their investors first the way they should. Sorry, this section, I'm going to polish them off. And then.
Can you talk a little bit about those very entertaining shareholder or letters to the CEO and the board of directors that you've written in the past, and kind of the motivation behind them, and why we haven't seen any letters like that over the last few years?
Honey, do you want to take that one? No, in case you don't know, the question was, I used to write, I guess we were best known at one point for shareholder activism, and I'll just give my Activism 101 module right now. So shareholder activism entails implementing change in a company, from the shareholder implementing change at a company in its board of directors, or in the management of the company, or in the strategy of the company, in order to create value. So I believe that there are 3 levers that you can pull. One is the financial lever. You can make a bid on a company. You can use financial muscle in one way or another, and use that to implement change. You can take over the company. The second one is the legal lever. You can engage in a legal battle. You can file lawsuits. You can change the board of directors through a proxy contest. I think that covers the legal angles. And the third one that was near and dear to my heart, particularly when we were a small fund, was using social pressure to try to affect change. And I think I was best known among hedge fund managers for writing very strongly worded, convincing letters to the board and to management, generally attached to a 13D, which is a filing that you make with the SEC when you go over 5%. And some of these letters, I just reread one. They're actually quite brilliant if you read them. Read one. Google the one I wrote for Intercept. I mean, these things read like spy novels almost. I mean, there's intrigue, there's hyperbole, there's revelations about things. There's all kinds of links to other things, and exposés. I have to say, if I can take credit for a couple things, I was the first person to really use the existence of corporate jets as to bash these guys over the head. And sometimes I'd find these guys with the worst beat up 1970s Citation, four-seater, and I would refer to their, tooling around in their luxury jets, drinking champagne cocktails and drinking and eating shrimp. But I don't do it anymore because it's an incredible time sink, and I found other more effective behind the scenes way of doing it. And ironically, though, because even though I don't really do this so much anymore, or don't do it at all anymore, the reputation's there. So managements tend to take our calls and don't want to get a letter. So, go ahead.
Slightly different line of questioning, but what's your favorite place to serve?
I can't tell you. No, because it's a secret spot in the Caribbean. But I will tell you my second favorite place to surf is in Indonesia. I went on a great surf trip, and in the Mentawai Islands. It's phenomenal, but it's hard to get to. So.
You talked about taking cues from the market. The government's talked about bailing out CMBS and TAL for some other ways. Is that something that's interesting to you? Do you think that's interesting now from either CMBS side or REIT equities or debt?
I think it's a fascinating area. Oh, I'm sorry. The question was, I mentioned taking cues from the market, and what about TALF and CMBS? Do you find that to be an interesting area? It's for us one of our fastest growing areas that we're allocating capital. We just hired someone to do that. We've put about, we've gone from 0 to 4% RMBS. We've just started buying CMBS securities, and for me, this is the part of the portfolio that I think we can make, high teens, low 20s returns on a very safe basis, and it's a $2 trillion. The mortgage market's a $10 trillion market. I'll talk about distressed for a minute. So distressed generally, there's $2 trillion of high yield issuance in the last 7 or 8 years, $1 trillion each in high yield and bank loans. There's a total of $10 trillion in the mortgage market, $2 trillion in residential and non-agency. So the agencies that back the bonds are agency bonds. The non-agency is $2 trillion. There's $1 trillion in CMBS. So that market's 1.5 times the whole corporate high yield market, and we're all over it. There are lots of opportunities, not because the government's coming in, but just because even with the recent run-up, the securities are really mismarked. They're complicated, and people don't have the infrastructure like we do. I mean, some people do, but a lot of people don't have the infrastructure to do the research on it. I love it.
Can I just build up those REITs as well? How does that fit?
We're finding better risk rewards in the structured markets than we are in the REIT equities. And what was the question up here?
Could you explain your transition from Citigroup to starting your own company and the challenges that you faced starting your own company initially?
Can I explain the transition initially from Citigroup to starting my own company? Sure. I don't know, any girls here that, like, when you were in junior high school, you were in love with a guy and you would write his name over and over on a piece of paper? Anyone do that? Come on, a hand somewhere. So I used to write down Third Point over and over, Third Point Partners, like for years. I used to just fantasize about starting my fund and how I would name it: Third Point Capital, Third Point Management, Third Point Investing. And then I'd scratch it out. I'd do logos. Like, this was like really like a dream of mine to get this thing going. And so, I left Citi in February, and the transition was just really, make sure I had some capital. I luckily had a good friend of mine who was a wealthy individual who promised to give me about $1.4 million, and a couple $100,000. I didn't have a wealthy family, but at least they were in a position, parents, aunts, a few other people gave me a couple $100,000 each. So that was really the start of Third Point, and that was just it. I mean, One day I stopped, literally the next day I went to an office. I quit Citi. The next day I went to an office. I started managing my own account as if it were a fund. And in parallel, I worked with my law firm, Wilkie Farr, my accounting firm on the documents. And on June 1, I started trading. I will tell you, the night before I started investing, I absolutely panicked. I thought, oh my God, what am I doing? Back to stories again. I said, I'm a fraud. I'm a fraud. I said, there's no way I can do it. Other people have entrusted me with their money. My mom, she doesn't have a lot of money. She gave me 250 grand. My dad, retired. What was I thinking? And I just bought a house, had a mortgage. I said, this is crazy. So luckily I was up 8% the first month, and you know, I didn't have that fraud feeling again for, you know, it crops up every now and then when you have a bad day or a bad month, even after 10 years, but not the fraud part, but you think, you know, maybe I'm not that good. In the back?
Are you more drawn to the fixed income quantitative side of things, or more objective risk part?
I'm sorry, can you ask the first part?
Are you more drawn to the like subjective, or rather objective, quantitative fixed income background, or the risk arbitrage? And also, do you view art investing parallel to risk arbitrage, where you're basically dealing with incomplete data sets?
Okay, so the question, I think, is objective versus subjective investing in fixed income and risk arbitrage, and how does that compare to buying paintings? Okay. I'll take the painting part first. And I've enjoyed collecting art. I've enjoyed art ever since, I'll tell you when. I went to Columbia, and I went to the museum. I went to the Met, and I saw Poussin's Rape of the Sabine Women. It's this incredible, epic. Did you guys know that painting? It's in the Met. It's a great, great painting, and it's anyway. And then I was at Columbia, and luckily Columbia had a core curriculum where you had to take, you know, an art humanities class, and there was the painting, and I felt like, you know, put up my hand, Poussin, I know and all the prep school kids, and they were like, what a jerk. Because, you know, I was excited that I knew this thing. It was like knowing, you know, the Mona Lisa or something. But to me, I was like really excited. And they all knew so much more than I did. But anyway, the teacher ended up I got one of 2 A's in that class, and all those prep school snotty kids didn't. So I loved art, and I took a modern art class. So I'd always followed art. And then I went to a show at the MoMA for some collector's show, and anyway, I got into it, and they're different art. So I really just started buying art as a passion. I never considered it an investment, and you know, it's ended up being a good investment. As far as subjective and quantitative, you can't separate the two. You need to understand. I mean, like I said before, being an investor and running a fund requires you to be part financial analyst, part accountant, part financier, part social scientist, part philosopher. And I think you really have to tie you have to tie the right brain and the left brain together. I think if there's an edge to be had, it's in understanding the different components of the analytical process or of the selection process, and understand that there's, you know, an element of, you know, creativity and emotion and analytics and intuition, and you know, maybe the thing we call intuition is just the ability to sort of tie all those things together. But
you mentioned one book earlier. Any other books you highly recommend? Favorite books?
which book did I mention? What?
Fine
Oh, Fine Bound. Oh, that was just a novel that I enjoyed. What kind of, like, books I enjoy reading for fun or investing?
Favorite books or things you recommend?
My favorite, I'll just tell you my favorite investing books that I tell everybody to read. You know, everybody's got to read, because it's such great history. Edwin Lefever's Reminiscences of a Stock Operator. Joel Greenblatt wrote probably the best book ever, You Can Be a Stock Market Genius. Financial Shenanigans by Shillett. The Art of Short Selling is another good book. There's actually a book I read recently that I really like. It's not about investing. It's about, I've been talking about story, and I stole some of his ideas, so I'll just tell you. It's a book called The Power of Story by a guy named Jim Lehrer. If you want to just sort of take it up a notch, that's a good book that I've enjoyed lately too. How about, let's go to that gentleman with the beard, unshaven.
I want to say thank you for continuing to support, particularly for the Israel Next New York and the
Oh, sure.
So very much appreciate that. But I wanted to ask, given what investors have now learned and their concerns post Madoff, and the majority of funds being within the say 50 million to 1 billion range, a lot of funds are facing an issue where they don't have a very deep back office. They don't have a lot of the infrastructure that's become even more important to investors that now, as you mentioned, have the power in allocating capital. Do you foresee a trend of consolidation between funds that maybe could benefit from putting together their different books and combining to have the ability to have a larger back office?
Yeah, I mean, so the question was, given the sensitivity, I'm going to paraphrase, given the sensitivities that the Madoff incident has created among investors, the greater requirements for infrastructure among hedge funds, and potential, you didn't say this, and potential regulatory requirements by the SEC, do you see consolidation among smaller hedge funds? And I would say yes. We're seeing it. I'm in the process right now of trying to fold in a really talented small hedge fund into Third Point and have it run as a standalone operation, but give them our back office support. All the way in the back on the couch.
Do you think the hedge fund industry would be regulated, subject to capital requirements such as grants? Will that affect the model? And do you invest your own money or you invest your investors' money? Do you have skin in the game?
Yeah, I mean, yes. So the question is, do I have skin in the game, and do I see regulation changing the industry in terms of capital requirements or other ways? So I'm the largest investor in Third Point, so I've got a lot of skin in the game. In fact, if Third Point went under, I'd be like one of those skinless chickens that you see in the market where they remove all the skin. That's how much skin I have in the game. So as far as regulatory, I mean, we already are regulated. I'm an SEC registered fund. Many of my competitors are. I don't know about capital requirements by the SEC that will be any greater than the existing Reg T requirements that already exist. But I don't see from a capital standpoint, I don't think it's an issue. It's more just from a reporting and compliance standpoint that'll be an issue. And just on the Madoff issue, I meant to say this to the last gentleman. Let's just all remember, even though the people's response to Madoff has been adverse to hedge funds in certain ways, let's remember that Madoff was not a hedge fund. He was a money manager who stole people's money, but he didn't have any of the normal checks and balances. He didn't have prime brokers. He didn't have proper auditors, but he didn't clear trades. He didn't do anything that a normal hedge fund does. So let's start going this way. Isn't that it?
What's your motivation now? What keeps you motivated? And what, because it's not the same as when you first started Third Point. So kind of what keeps you motivated now and what's been the most difficult part of running Third Point?
Well, you haven't seen my bills. So, no, look, I mean, one, it's really fun. I mean, I love, it's solving for me, it's solving a puzzle, constantly solving a puzzle that's never really complete. My son likes to play with puzzles and he always gets to finish it and it's done, but this puzzle is always kind of morphing into different directions. So whether it's the organizational puzzle or the investment puzzle, those are two really interesting things. And I think it's an interesting, for me, as I've gotten older, it's a really interesting laboratory for me to employ things that I'm thinking about and doing in other parts of my life, and creating a community for people, and also, interacting with the world in a way as a financier to get things done. The second thing is just from a financial standpoint, I feel like my work is just getting started as a philanthropist, and I'm hopeful that this will continue to be successful and that I can give back. And I know my wife feels the same way, that she has a lot of interest too, whether whole range of things. So those are a couple things, and I don't know what else I've been. I like surfing, but I can't surf that much. And also, I think I would drive my wife crazy if I was home all day in my bathrobe, hanging around. So.
You keep mentioning Madoff, and since we're a Jewish group, I'm wondering how your outlook on the world has changed or been affected by that, and also, I guess more importantly, if you could talk about your philosophy as a Jew and how that has helped you in your career.
I keep mentioning Madoff, and what? That's why I was just repeating the question. But so the question started with a statement, which is that I keep mentioning Madoff, and how is that? What was the question? How is that affected? I was thrown off by a heckler in the audience. It's a tough. Sorry.
You said that Madoff affected the way that hedge funds are perceived.
Right.
But how has it affected the way that Jews, successful
Okay.
Jews,
Good.
are
Very good
perceived?
question. So how hedge funds have affected the way Madoff has affected the way that hedge funds are perceived. How has that affected the way Jews are perceived, and how do I feel that being a Jew has shaped my outlook as an investor?
Your investor, your philosophy. What is your philosophy being a Jew?
That's a heavy question, but very apropos given the environment. So on the Madoff side, I mean, this has been well discussed. There have been a lot of meetings about this, and the backlash about Madoff and Dreyer. But by the way, Dreyer was not Jewish. Did everyone know that? Mark Dreyer, the lawyer who absconded with people's money, but you didn't mention that. But it's funny that people thought he was. But no, the Madoff thing was a terrible thing. I mean, what can you say? I mean, it's one thing to steal people's money. Okay, you're a bad guy, you steal people, but you steal the Eli Wiesel Foundation's money? I mean, does it get lower than that? I mean, this guy was a creature, and I think that, look, it's an awful thing. I mean, I don't know what to say. I mean, all kinds of people do bad things. It's unfortunate that he was Jewish, and it reflected poorly on him, the financial industry, Jews. I don't know what good you can say about it, except that what a rare exception he is. I mean, I know it doesn't seem like it because you keep hearing about these bad actors in our industry, but I'd say that there's actually a surprisingly, people have acted surprisingly well in the hedge fund industry. The people I know are extremely, ethical. Whether it's fearful of regulators because the repercussions are so bad, but understanding that they have a good thing going, they don't want to blow. They're just decent people. So, as far as my own philosophy from a Jewish perspective, I'd say many of my own personal explorations in life has emanated. I think when I first started studying with Rabbi Hedge, I was I would say I was much more identified with my day-to-day, moment-to-moment activities. Studying Torah with Hedge and studying Torah in general it was really the first time in my life where I had a framework that I could refer to. And many of the things I've talked about today, and I'd maybe talk about this with Matt later, there's probably things that I've talked about not in a Jewish context that I believe also have grounding in, what I've found when because sometimes I'll talk about philosophical things that I've learned outside of Torah. With Hedge, I'll say, oh, of course, that's in this Kabbalistic text. We got there first, blah, blah, blah. So I think but I think the main thing I've gotten about it is just having a very principled approach and having a framework and being able to refer to something that's bigger than us. And it's not just bigger than us, but kind of lays out for us sort of a set of principles that you can apply to your life. And the other side of it is just, I wasn't married. I was single. I was having a good time, I thought. But you know what? I've had a much better time being a family guy. And I give my Jewish study some credit for kind of getting me over the hump there and making the choices that I've made in that part of my life, which have been all this great stuff about the hedge fund. That part's even been better. Next question. Right there.
How long do you spend analyzing an investment, a potential investment?
Is that just the question? How long do we spend analyzing an investment?
Like if you're gonna pick an equity, you're gonna pick a security.
It depends on the scenario. I mean, there may be things that we study for weeks on end. There may be something that comes up, a news flash, some news crosses the screen. I don't even crack a balance sheet, but I know that this is a material event. I might just look at a research report because I don't have time to do my own analysis, and we'll buy it. There was a little blurb about a Canadian company that had a rumor of a bid from a Korean company, and it kind of smelled right, so I read a research, and that took about 3 minutes. There was it was a small investment. It was about a $7 or $8 million investment. We've spent, the last couple of weeks studying AIG and have been slowly building a position in different complex securities in there, and that has entailed consultants and lawyers and poring over it. So it's all over the place. And then it's an ongoing process. Right behind him, the gentleman with the tie.
How many people do you have in your investment management team, and how is this structured by industry groups?
We have 50 employees, 20 people investing, 2 traders, 18 analysts, including myself, and 4 people doing distressed debt, one of whom does mortgages, people specializing in financials, technology, cyclicals. Basically, that's it. And 2 guys doing short selling. In the back standing.
In response to an earlier question, you had said you think inflation is a huge risk, but you also mentioned that you took off a lot of your macro trades.
Uh-huh.
So I'm curious, it's a 2-part question. The first one is, isn't it possible that a lot of the signs that the story's changed in the world, that there's recovery, could be the early stages of inflation? And whether or not you agree with that, if you think that you need to hedge against inflation, how do you resist fully expressing that view by putting back on the rate caps or steepeners, by taking positions in commodities and doing other things that are, from what you said before, outside your core focus?
No, that's a good question. So what we try to do, if we have that view, is pick out within the portfolio, companies that are going to benefit from inflation. So I don't have to buy, copper futures. I could buy, a copper mining stock, and maybe a copper mining stock that's in the midst of, that's a potential takeover target. Even better if there's like an event element. Like I said before, there are companies with certain real estate assets, not commercial, but more like apartment and hotel assets. So there are different ways to express that. I'm not like turning a blind eye to the macro factors. It's just, from a marketing standpoint, but also just in terms of focusing the organization. For us, and this isn't for everyone, we're just better off focusing on, specific actionable equity and credit investments rather than all that other stuff. Take 3 more questions. Is that okay, Matt? Okay. And then afterwards, I'll stay for a few more minutes if people
you
want.
brought up financing, or just to step back, you brought up philosophy. To actually be a good investor, you have to be a little bit of a philosopher. What advice would you give to someone who actually studied something along those lines, who wants to get into the world of finance? There was a story of Eugene Lang. And, I mean, there's no meaningful jobs out there. I doubt there will be anytime soon. So I'm really have the mindset that money's in your hunting, and everyone's really hungry. What would be your best best course of action to try to get to that world?
Well, I mean, you need the basic skill set to, I'm sort of speaking metaphysically, I mean, not metaphorically, not metaphysically. So, you know, you need, I mean, in addition to being a philosophically minded person, it's helpful if you know how to read financial statements and understand economics.
If you can do that, what would be the best approach?
I mean, there are a lot of, there are jobs in investment banking where they teach you, they take people from liberal arts. The people who I've seen succeed in that have gone into investment banking training programs and learned the skill set that they need to learn, and they've gone on from there. And then there's always graduate school of business.
Any companies that you know that are doing well?
That are.
Where they're looking for people.
I don't know. I mean, I'm sorry. I mean, and I know I've been through this. I mean, one thing, I don't know if this is encouraging or discouraging. I was out of work for 9 months in 1989 between jobs, and I know what it's like to really want to get into something, feel you have a, you know, and doors were just being shut to me left. But I took every day was a job, looking for that job, and I would hear about a possibility, and I'd drive somewhere.
Was there any nepotism involved with you getting a job? Or was
no, my first job there was, but then after that there was never nepotism, just networking and. So there's a woman. I don't think I've had any questions from women, so there's. Except, what's that?
What your thoughts are on Senator Cole's letter from the Mountain Council?
I'm sorry, if you could just speak a little louder, I can't hear you.
I was wondering what your thoughts are on the letter that Senator Cole from the Mountain Capital wrote about clearing critical swaps between the buy side and the sell side.
That's an easy. The question is the Cole letter from Blue Mountain about clearing derivatives, and that's and what my thoughts were about that letter. And unfortunately, so, and if I haven't read the letter, how do I feel the derivatives clearing, how derivatives clearing is going to affect that market? I mean, I'm happy to say that we just have so little dealing with derivatives and CDS that it just isn't going to. It may affect me indirectly because it'll affect markets because derivatives have some sort of, you know. But I don't have a. It's just not my world, so I don't know. Sorry. How about in the back there?
You said that you benefited off of Chrysler bonds.
Yes.
In terms of how the administration currently is handling, the fixed income investors in auto companies, and especially around the GM and Chrysler dissenting bondholders.
Mm-hmm.
How do you feel like what's your outlook on how the legal structure of the country has been changing in terms of how it's treating stakeholders?
I will repeat the question. So the question is, given what's been going on in GM and Chrysler and the way the government has treated bondholders, what is my outlook? What's my take on how stakeholders are being treated, and how's the system going to evolve? So my take on it is that, you know, each of these situations were troubling, but also somewhat unique. And I'm going to address the Chrysler situation, but I'm also going to address another situation that just came about in a company you didn't mention, which was Delphi. So just so everybody in the room knows, I'm sorry if this is too technical, but first of all, I had mentioned the Chrysler bonds that we invested in and profited from were the Chrysler finance company bonds, not the car company bonds. And the finance company was a ring-fenced separate entity which is being liquidated, and these bonds will be paid off in full. The car company, on the other hand, received differential treatment, inferior treatment to the similar creditors, to other creditors that were at the same, that were effectively in the same class involving claims by the United Auto Workers Union. Now, what proponents of the government's position, and the government basically paid a disproportionate amount out to the union than they did to the car company bondholders. And I'll just call them the Obama haters, criticized this because the rights of creditors, the rule of law was being ignored and the rights of creditors were being impaired. The Obama lovers, on the other hand, said that, well, were it not for the government's intervention in this in the first place, those bonds would be squashed. They should be lucky they're getting the 15 cents of recovery that they're getting anyway and stop whining and being un-American. And my take on it is it's an unusual situation. I'm a little bit sensitive to the Obama position and to the other situation. What I'm more fearful of is in other situations where the rule of law and the rights of creditors are not upheld. So let's move on to the GM situation. In GM, initially, the unsecured creditors were given an inferior package, once again, relative to the other union creditors who were given a lot more. At the end of the day, they were given a different package, but the bondholders were given more, and they finally signed on to a deal where instead of health care and other things, they got warrants in the ultimate GM recovery. Everybody agreed. I think that was an okay outcome. There was another case, though, more recently that was much more troubling, and this involved Delphi. And Delphi is an auto parts maker, and there were a group of, does everyone know what a DIP lender is? Debtor in possession. So in order to emerge from bankruptcy, certain senior creditors agreed to put fresh money into Delphi. And for doing so, they were given a super senior position in the Delphi credit and should have been protected. They should have gotten the first claim on anything that came out of Delphi. Well, as the company came out of bankruptcy, a plan was put forth whereby the DIP lenders got a recovery of only 17 cents on the dollar. Boo. That's really bad. Rule of law wasn't being upheld. And the good news is that this evening, luckily we do have, Obama and his administration, they're not emperors. And Judge Drain in the bankruptcy court this evening ruled that that is not kosher. Go back to the drawing boards and figure out something that's right. So luckily, we still have independent bankruptcy judges that can opine on these matters and hopefully bring some sanity to these issues, particularly when there's cut and dry as the Delphi case. I think the other one, so it's a long way of saying that it's a very important issue. I think the government may be overreaching in certain instances, but luckily we have a court system that, in theory, can serve as a check. And we have one of the preeminent lawyers in the room. I'll let him remain anonymous, but I'll ask him afterwards how my answer was. So go back over here. Let me try to cover.
Tonight we've been talking a lot about making money, and I know that philanthropy is very important to you. So we're a young, hopefully money-making crowd. Is there anything that you can say to kind of motivate us to give back to our communities and be more philanthropic?
I mean, I think that's such a personal question. I think, everyone does what they feel is right, and I don't.
What motivates you to?
Oh, I'm sorry, I forgot to answer the question. So this is so what can I say to kind of motivate people to give back? Well, I was actually at a very interesting, it's a great question. I was sitting in the equivalent of your seat. I was at this thing at the library, and there was a very famous hedge fund manager there, and there was a guy questioning him from Business Week, and the guy from Business Week said, "Mr. So-and-so," I won't mention his name, you've made so much money. And this guy was a billionaire. He made a lot of money. And he said, what's your philosophy on charity? And he said, well, charity, I don't know, how many of you read Ayn Rand? He had very much the Ayn Rand view that, individuals, charity isn't necessary. Not only is charity not something you should aspire to, but they think it's kind of a bad thing because it takes away people's personal whatever. So he said, charity is something I'll think about towards the end of my life. The society is better off if I reinvest my capital now and give it back, 50 years from now after it's accumulated a lot. And then that is just, to me, so wrong. First of all, let's just take a hypothetical. Let's say that you support a local hospital or some local medical research, and someone you know or love is afflicted by a disease that could have been discovered with money you could have given. Or let's say that you could have helped a community and people's lives could have been changed during your lifetime. But let's say someone who might otherwise have been helped by that charity decided to become a thug and mugged and hurt someone in your family. There's just a lot of reasons why I think that's wrong. By the way, this guy was down like 60% the next year, so the society would have been much better off had he given it away. So then an older, very distinguished gentleman came up. It was a beautiful thing. He got up and he said, respectfully, Mr. X, I just want to offer my perspective. He said, I'm 77 years old. I still work very hard. And I don't need the money. Like yourself, I don't need the money. He said, I didn't make as much money as you did at your age. It's incredible what you kids are doing these days. But the reason I work so hard is I enjoy giving it away. And he said this so eloquently. He said, I just put it to you. I just would like to suggest, it was so soft the way he said it, but it was so forceful. He said, maybe you should try it. It feels really good to do it. And that's all I would say. I couldn't say it any better than that, gentleman. It just feels really good when you've seen the impact, whether it's supporting this organization and seeing all you guys getting together and knowing the good that it's come, or other things that we've supported. It's, makes you feel good. There's a guy on the couch who had a question.
You spoke a couple times about the fear of inflation. What do you feel about the possibility of American dollar being replaced as a standard currency, as China's suggesting? Do you feel the existing currency?
The question is, back to the mundane realm of inflation. I've mentioned inflation as a potential issue, and it's come up this evening. What about the issue of the U.S. dollar as a standard currency? Will it be replaced? And so it won't be replaced. There's a lot of talk about, whether it's from the Russians, Middle Easterns, Chinese, about, baskets of currencies or even gold. But, I don't see the euro, and I don't see any other currency replacing the U.S. At least not for the next 10 years, which is my time frame. Over there, I lied. I said 3 more questions. I'll take 2 more questions. So one here.
What's your philosophy on detecting and rewarding top performers?
I'm sorry, philosophy on
detecting and rewarding top performers.
What's my philosophy on rewarding, on attracting?
Detecting. Finding them.
Oh, detecting. I'm sorry. What's my philosophy on detecting and rewarding top performers? In terms of finding potential, you mean like how do I hire people, or finding them within what?
Out of those that are already hired.
Oh, I mean it's pretty easy to detect the top. And when you say top performers, I assume you mean within the investment management. So the question is, how do I detect and reward top performers? Top performers make themselves apparent in a few different ways. One, they exhibit the kinds of qualities and they demonstrate practices reflective of the types of qualities that we value. Teamwork, excellence, all that, diligence, and they help the organization. They think about the organization above just themselves. And the second thing is they come up with and they work on actionable, highly profitable investment ideas. So those are the two criteria. And you reward them by paying them a portion in two ways, financially and by kind of moving them up in terms of their responsibility and role in the organization, with the ultimate goal being a partner in the organization. Last question. Anyone? We'll end up right here.
I have a question. If hypothetical scenario where if you were in our shoes during this time, how would you try to get ahead during right now? Like when you were just starting out, Drexel and the Milken were big, and the debt was big. What would you get into right now?
Good question. So if I were in the shoes of someone who was just getting into the business right now, what would my suggestion be? And I actually think that you mentioned Milken. I actually think the wheel has come full circle again. I think we're at the early stages of one of the great restructuring opportunities of all time, and whether it's in corporate debt, structured mortgage debt of either residential or mortgage securities, or the real estate business itself, there's going to be a massive amount of restructuring and need for professionals, investors, all kinds of peripheral people to deal with these trillions and trillions of dollars of restructurings that are going to happen. So that's where I'd be heading. That's where I'm heading as a firm. So on that note.
I wanted to thank you for coming and sharing your It's our sort of hope that everybody in this room will sort of sneak into their own story in bands, and then that holistic approach that you sort of began with, that you should integrate your Jewish lives, your business lives, your family lives, all your various lives that I think Dan spoke about so well. I hope that that's one of the big takeaway messages for you tonight.
And that getting married is good.
So thank you again. Thank you for being here.
No. And I wanted just to thank the JEC. I didn't figure that out because I always go to these JEC things. I'm like the old guy. And I thought, well, why am I doing? So they actually have this outreach program, which is separate from what they do with you guys. And I just want to say, I mean, the JEC has been a really important thing in my life too. Not the part you guys do, but the parts they do for the old guys. So I want to thank, Matt and Hedge, who's not here. Is he here? Junior Hedge's here. But he's representing. So I want to thank the JEC for everything you guys have done, and it's great to be part of. And thank my wife Margaret for coming. And I've never spoken so much in a time that my wife has spoken so little in probably our entire marriage. So thank you, honey, for coming.
Sat through plenty of investor dinners.
Okay, thanks so much.